Listen carefully. I am not talking about a normal market environment. I am not talking about another temporary slowdown that policymakers can easily smooth over. I am not talking about a routine cycle that ends with a few interest rate adjustments and a return to business as usual. What I believe is developing is much larger. And if you understand the framework that investors like Ray Dalio have spent decades studying, you begin to realize that the real risk is not volatility. The real risk is assuming that the conditions of the last several decades can continue indefinitely. History does not support that assumption. When I look at major economic transitions throughout history, I repeatedly see the same pattern emerge. Debt expands for years, credit becomes easier to access. Asset prices rise, confidence grows, governments borrow more, corporations borrow more, consumers borrow more, markets reward risk-taking, success reinforces even greater risk-taking. Then eventually the system reaches a point where debt begins growing faster than the productive capacity supporting it. That is when the pressure starts building beneath the surface. Most people do not notice it at first because the system continues functioning. Markets continue operating. Spending continues. Headlines remain relatively calm. The appearance of stability remains intact, but appearances can be deceptive. The reality is that debt-driven systems always encounter limits. The exact timing varies, the specific trigger varies, but the underlying mechanics remain remarkably consistent from one era to the next. This is why long-term debt cycles matter. You need to understand that debt is not inherently bad. Debt can accelerate growth. Debt can finance innovation. Debt can support investment. The problem emerges when the accumulation of obligations begins outpacing the ability of the economy to generate the income required to support them. Once that happens, policymakers face increasingly difficult choices. And that is where today's environment becomes particularly important. Across many of the world's largest economies, debt burdens remain extraordinarily high. Government obligations continue expanding. Fiscal deficits remain persistent. Interest expenses consume a growing share of public resources. Demographic trends create additional pressure. Productivity growth struggles to keep pace with financial commitments that continue increasing year after year. These are not temporary challenges. These are structural realities, and structural realities eventually demand structural responses. Most investors still approach markets as though the next decade will resemble the previous decade. They assume monetary policy will continue providing solutions whenever instability appears. They assume policymakers possess unlimited flexibility. They assume financial conditions can always be adjusted in ways that restore equilibrium. I would encourage you to question those assumptions because the higher debt levels rise, the narrower the available options become. Think about the dilemma. If interest rates remain elevated for an extended period, debt service costs increase. Economic activity slows. Financial stress grows. Weakness begins spreading through different parts of the economy. But if policymakers respond aggressively with liquidity and monetary accommodation, a different set of risks emerges. Currency purchasing power comes under pressure. Inflation expectations become more difficult to contain. Confidence in long-term monetary stability begins to weaken. Neither path is painless. Neither path offers a perfect solution. History shows that heavily indebted systems rarely escape these pressures without significant adjustments. And this is where the conversation begins shifting toward silver. Not because silver exists in isolation. Not because silver is magically immune to volatility, but because silver sits at the intersection of several powerful forces that are beginning to converge simultaneously. That convergence is what deserves your attention. Most investors still view silver through a narrow lens. They see a commodity. They see a metal that experiences periodic rallies and corrections. They see something that rises and falls based on sentiment. What they fail to recognize is that silver occupies a unique position inside the broader financial system. It is both a monetary asset and an industrial asset. That distinction matters far more than most people realize. When monetary uncertainty increases, investors often seek assets that cannot be created through policy decisions. They begin looking for scarcity. They begin looking for tangible stores of value. They begin looking for alternatives to assets that depend entirely on confidence in expanding debt structures. At the same time, industrial demand follows an entirely different path. Manufacturers do not care about financial narratives. They care about production requirements. They care about materials. They care about functionality. They care about supply availability. And silver remains deeply embedded in technologies that are becoming increasingly important to the modern economy. Now consider what happens when both forms of demand begin strengthening at the same time. That is where the situation becomes interesting, because major market moves rarely originate from a single factor. They emerge when multiple forces begin reinforcing one another. Debt pressure alone is not enough. Monetary uncertainty alone is not enough. Industrial demand alone is not enough. But when several powerful trends start moving in the same direction, the probability of significant repricing increases dramatically. This is why I believe many investors are focused on the wrong questions. They ask whether silver can rise. That is not the most important question. The more important question is whether the financial environment supporting silver is becoming stronger. The more important question is whether debt expansion, monetary pressure, fiscal stress, industrial demand, and changing investor behavior are beginning to align, because if they are, then the conversation changes completely. And what makes this moment particularly important is that many of these forces are no longer theoretical. They are already visible. They are already influencing policy decisions. They are already influencing capital flows. They are already influencing investor psychology. The majority simply has not connected the dots yet. And throughout financial history, that is often how the biggest opportunities begin. The crowd usually recognizes structural change late. The crowd waits for confirmation. The crowd waits until the evidence becomes obvious. But by the time structural shifts become obvious, much of the repricing has often already occurred. That is why understanding the larger framework matters, because what is developing beneath the surface today may ultimately prove far more important than the daily headlines capturing most investors' attention. And the rare debt convergence that Ray Dalio has warned about becomes even more significant once you examine how governments, central banks, and global capital are likely to respond when these pressures continue intensifying. The reason I want you to think carefully about this debt convergence is because most people misunderstand how major financial transitions actually unfold. They imagine a sudden event. They imagine a dramatic collapse. They imagine a single headline that changes everything overnight. History rarely works that way. The most important shifts usually begin quietly. They develop beneath the surface while the majority remains focused on short-term market movements. Confidence remains relatively stable. Asset prices continue functioning. Economic activity continues moving forward. And because nothing appears broken, most people assume the underlying system remains healthy. But gradual deterioration can be more powerful than sudden disruption. When debt burdens continue expanding year after year, policymakers eventually become constrained by realities they cannot easily avoid. Every decision begins creating new trade-offs. Every solution generates additional consequences. Every attempt to stabilize one area introduces pressure somewhere else. That is exactly what makes late-stage debt cycles so important. As obligations grow larger, the system becomes increasingly dependent on favorable financial conditions. Low borrowing costs become necessary. Continuous liquidity becomes necessary. Stable confidence becomes necessary. The margin for error becomes smaller. Eventually, the entire structure depends on maintaining conditions that become increasingly difficult to sustain. This is where investors need to stop thinking in terms of individual market events and start thinking in terms of incentives, because incentives drive outcomes. Governments have incentives. Central banks have incentives. Financial institutions have incentives, and when debt reaches extreme levels, those incentives often begin pointing in the same direction. The objective becomes managing the burden rather than eliminating it. The objective becomes reducing pressure gradually rather than accepting immediate pain. The objective becomes preserving stability for as long as possible. That sounds reasonable, but history shows that these efforts frequently produce long-term consequences that many investors fail to anticipate. When policymakers attempt to manage excessive debt through monetary accommodation, liquidity expansion, or financial repression, the effects are not always immediately visible. Markets may initially celebrate. Economic activity may temporarily improve. Confidence may remain elevated, yet beneath the surface, purchasing power often begins a slow adjustment. And that adjustment matters enormously because wealth is not measured by account balances. Wealth is measured by what those balances can actually buy. A portfolio that rises numerically while purchasing power declines is not necessarily becoming stronger. That distinction becomes critically important during periods of monetary stress. This is one of the reasons silver has historically attracted attention during major transitions, not because it generates cash flow, not because it promises certainty, but because it exists outside the debt creation process itself. It cannot be printed into existence through policy decisions. It cannot be created by expanding a balance sheet. Supply responds differently than financial assets whose availability can increase rapidly through credit creation. That characteristic becomes increasingly attractive when confidence in traditional monetary frameworks begins weakening, and confidence is ultimately the key variable. Modern financial systems function because people believe in them. Currencies function because confidence exists. Debt markets function because confidence exists. Valuation models function because confidence exists. Most of the time, confidence remains strong enough that people rarely think about it. But during periods of transition, confidence becomes visible because behavior begins changing. Investors start asking different questions. They become less focused on maximizing returns and more focused on preserving purchasing power. They become less interested in speculation and more interested in durability. They become less concerned with short-term performance and more concerned with long-term resilience. When that shift begins spreading across institutions and individuals, capital allocation patterns start changing, and capital flows are what ultimately move markets. Now add another layer to this discussion, because the silver story is not solely about monetary concerns. It is also about demand. This is where many conventional analyses become incomplete. They focus almost entirely on silver's role as a store of value while ignoring its growing importance within modern industry. That is a mistake. Silver possesses characteristics that make it exceptionally valuable in applications requiring conductivity, efficiency, and reliability. As technological infrastructure expands, as electrification advances, and as increasingly sophisticated systems become integrated into the global economy, the importance of those characteristics grows. Industrial demand is fundamentally different from investment demand. Investment demand can fluctuate based on sentiment. Industrial demand is driven by necessity. Companies purchase materials because production requires them. Factories purchase inputs because operations require them. Infrastructure projects require components regardless of market narratives. That creates a powerful dynamic, because when industrial demand remains firm while monetary demand begins increasing, supply-demand balances can become increasingly sensitive. Many investors underestimate how quickly markets can reprice when perceptions begin changing. They assume future movements will resemble past movement. They assume historical ranges define future possibilities, but markets are not static. Valuation frameworks evolve, narratives evolve, behavior evolves. And when multiple drivers begin reinforcing one another simultaneously, outcomes that once appeared unlikely can suddenly appear reasonable. This is where the possibility of substantially higher silver prices enters the discussion. Notice that I said possibility. No one knows exact timing. No one knows exact levels. No one can predict the precise sequence of events. Investors do not need certainty to identify powerful trends. They need probabilities. And when I examine the combination of debt expansion, fiscal pressure, monetary constraints, industrial demand growth, and changing investor psychology, I see a collection of forces that deserve serious attention. The important point is not a specific number. The important point is understanding what could drive a dramatic reassessment of silver's role within the financial system, because major repricing events rarely occur when everyone expects them. They occur when assumptions begin changing. They occur when confidence begins shifting. They occur when investors suddenly recognize that old frameworks no longer explain present realities. History has shown this repeatedly. First comes disbelief, then comes awareness. Then comes participation, then comes momentum. And once momentum develops, markets can move much faster than conventional analysis suggests. That is why the convergence matters, not one factor, not two factors, but several powerful forces moving together. And what happens next becomes even more important, because the relationship between investor psychology, institutional capital, and monetary confidence may ultimately determine whether silver experiences an ordinary cycle or something far larger than most market participants currently imagine. Now, I want you to focus on the factor that is often underestimated until it is already influencing every major market. Psychology, not economic theory, not academic models, not forecasts, psychology. Because markets are ultimately driven by people, and people do not make decisions based solely on data. They make decisions based on perceptions, expectations, incentives, and confidence. That is why some of the largest market moves in history have appeared irrational at the beginning. The underlying fundamentals were already changing. The structural pressures were already building. The signals were already visible, but the majority had not yet adjusted its thinking. Then suddenly perception caught up to reality, and when that happens, capital moves. This is the phase that deserves the greatest attention. Up to this point, we have discussed debt expansion, monetary pressure, fiscal challenges, industrial demand, and the unique characteristics that separate silver from many other assets. Those forces create the foundation, but foundations alone do not create major repricing events. Behavior creates major repricing events the moment investors begin reassessing risk, opportunities, purchasing power, and long-term wealth preservation. Allocation decisions begin changing. At first, those changes are small. A few institutions adjust exposure, a few funds alter strategy, a few family offices begin increasing attention toward hard assets. The broader market barely notices, then more participants start observing the same conditions. Questions begin spreading, conversations begin changing, the narrative evolves, and eventually momentum develops. This pattern has repeated throughout financial history. The majority rarely moves first. The majority waits. The majority seeks confirmation. The majority prefers certainty. But certainty usually arrives after the opportunity has already become obvious. That is why awareness remains so valuable. Awareness does not eliminate risk. Awareness does not provide perfect predictions. Awareness simply allows investors to recognize developing trends before they become widely accepted. And when we look at today's environment, there are several developments that deserve attention. Debt burdens remain historically elevated. Government obligations continue expanding. Fiscal deficits continue accumulating. Scarcity purchasing power remains vulnerable. Monetary authorities remain constrained. Global competition continues intensifying. Supply chains continue evolving. Economic growth remains uneven. These forces do not operate independently. They reinforce one another. Together, they create an environment where confidence becomes increasingly important, and confidence is far more fragile than most people realize. For years, investors became accustomed to a financial environment that rewarded risk-taking. Liquidity remained abundant. Debt remained manageable. Asset prices generally benefited from supportive conditions. Many market participants came to view those conditions as normal. History suggests they were not normal. History suggests they were exceptional, and exceptional conditions rarely last forever. That is why Ray Dalio's warnings about debt cycles continue attracting attention, not because debt automatically causes collapse. Not because every cycle ends the same way, but because excessive debt eventually forces adjustments. The larger the imbalance becomes, the more significant those adjustments often become. Sometimes they occur through restructuring. Sometimes they occur through inflation. Sometimes they occur through monetary dilution. Sometimes they occur through combinations of several mechanisms. But the adjustment arrives nonetheless. This is where silver becomes increasingly relevant, because silver exists at the intersection of multiple trends that could strengthen simultaneously during a period of debt-related transition. Industrial demand continues supporting its practical value. Monetary demand can support its financial value. Scarcity supports its long-term significance, and changing investor behavior can amplify all three. Very few assets occupy that position. Most assets depend heavily on one dominant source of demand. Silver benefits from several. That does not guarantee outcomes. Nothing guarantees outcomes. But it creates conditions that investors should take seriously, especially when the broader financial environment appears increasingly unstable. This is why discussions involving silver are not merely discussions about a commodity. They are discussions about monetary confidence. They are discussions about purchasing power. They are discussions about debt sustainability. They are discussions about how investors respond when existing assumptions begin breaking down. And if confidence continues shifting, the implications could become substantial. Because once investors begin reassessing the role of silver inside a changing financial system, Valuation frameworks themselves can change. That is the critical point. Most people focus on price targets. Sophisticated investors focus on drivers. Price follows drivers. Drivers create price. If debt pressures continue expanding, if monetary responses continue accumulating, if confidence questions continue emerging, and if industrial demand remains strong, then the forces supporting silver could become increasingly difficult for the market to ignore. At some point, institutions begin paying closer attention. Funds begin paying closer attention. Large pools of capital begin paying closer attention. And when significant capital starts pursuing limited supply, market dynamics can change rapidly. History has demonstrated this repeatedly. The biggest moves often seem unrealistic beforehand. During the move, they seem surprising. Afterward, they appear obvious. That sequence has repeated again and again across generations. The investors who benefit most are rarely those who predict every detail correctly. They are usually the ones who recognize major structural trends before consensus forms around them. That is why preparation matters. That is why discipline matters. That is why understanding the larger framework matters. Because transitions create both danger and opportunity. Those who ignore structural changes often discover that old assumptions no longer provide protection. Those who understand structural changes are better positioned to adapt. So as you think about silver, do not focus exclusively on daily fluctuations. Do not focus exclusively on short-term headlines. Look deeper. Watch the debt cycle. Watch fiscal conditions. Watch monetary policy. Watch real purchasing power. Watch industrial demand. Watch capital flows. Most importantly, watch confidence, because confidence connects all of these forces together. And if the rare debt convergence that Ray Dalio has discussed continues unfolding in the direction many indicators currently suggest, the possibility of silver moving toward levels that seem extraordinary today may not be as unrealistic as many investors believe. The market rarely announces major transitions before they happen. It reveals them gradually, then suddenly. The investors who understand that reality are often the ones best prepared when repricing accelerates. That is why this moment deserves attention. That is why awareness matters. And that is why the convergence forming today may become one of the most important financial stories of the years ahead.